And everybody, it's Tim Reazor, the Chief Investment Strategist here at Revere Asset Management, just after 4:30 on a Thursday night. So very quickly, stock numbers, market orders. Before we begin, listen, we're going to do the video podcast. We usually tape it Friday afternoons. And it gets out Saturday, it gets sent out Saturday mornings, and it's normally placed in here. But for those in the know, like my friends that watch these videos nightly, I place the video podcast the moment it's done, the moment I get it uploaded to the servers. I place it in the Daily Market Insight tab of our website. Go to Revere Asset, and Friday around 5 o'clock Central, you will see it appear in there. And you can start your Saturday weekend research early on Friday night and watch not only the normal video like you're watching right now, but the bonus Saturday video podcast as well. And so a video podcast is by far the most popular thing we produce every week. It's amazing how many people worldwide watch it, and I'm grateful for that. And so thank you. But early access you can find right in that tab there Friday nights. And if you have any questions, concerns, comments, take umbrage with anything I'm saying, can't find the video podcast tomorrow night under that tab I just mentioned, just email me, tim@revereasset.com. Want to talk to the portfolio extraordinaire, one of the best in America right here. Don Vandenborg, Don at Revere Asset, America's fiduciary right here, keeping people out of horrible investments and educating everybody every day that life insurance is not an investment. It gets sold that way, but it's not. I swear to God, it's not. And so if you have any questions about that, or it sounds controversial in your head, or you are a salesperson and you take umbrage with that statement, what I want you to do is call 855-732-5932. We invite the discourse, we invite the discussion, we invite you asking why is insurance one being sold as an investment, and why are you, Tim and Danny, saying it is not and you should absolutely positively avoid it. 855-732-5932. We don't sell any products like that. And then stock nerds and market lovers, if you are considering becoming a client of the firm, we'd love to have you. But listen, don't ever hesitate to email us questions. If you've got a question you're sitting on, strategy-wise, something with yourself, don't ever hesitate to reach out to us. We don't have salespeople. So if you have a question, you're going to get an answer, and we're going to move on, and you're going to move on, and it's going to be great. And that's the reason why we grow, is because of the way we treat you. And so if you just have questions, please, we're grateful. Like, I can't begin to tell you, like almost 1,000 hours of our videos have been watched in the last 30 days. That's just tremendous for a little shop our size. The fact that so many stock nerds globally are watching our content, it's a lot of minutes watched of videos, folks. And then listen, I used to give out my phone number, but I don't right now because the phone would just blow up all the night. And so at TJ, yes, I know I can mute it, but it's easier for me here on Twitter. So at TJ Reazor is my Twitter handle. If you follow me, I will follow you back. Just let me know, hey, Tim, I followed you. And then you can direct message me anytime. It's the closest thing you're going to get to Twitter. You can do the same thing with Danny and Don as well, and D Vandenborg and one Danny Stewart are their Twitter handles. So with that, my fellow stock nerds, market lovers, these videos, they are for what? Your edification purposes only. They're never ever to be misconstrued as advice. If you want advice, you need advice. If you seek advice, all you have to do is, in fact, give us a call right here. That's 855-732-5932. Let's talk risk. Put call ratio. Listen, this put call ratio is super duper low. Everyone is still pretty bullish. It's a contrary indicator the way I describe it and the way I use it. And right now, people are still loaded. I'm trying to spell loaded, and I'm struggling with my mouse. L-O-A. I'm trying to make an A. Still loaded up on those calls. And so, well, how would I know that? Because the 10-day per call moving average is still down well below 0.65. And the ratio is below 0.65. Look, I get excited and I want to be leveraged long, and it's contrary, right? As this 10-day moving average would move up beyond 0.9, which would put the put call ratio somewhere maybe up in this area, which means everybody is bearish, and that's kind of when you want to get a little bit of bullishness and some exposure, looking for a bounce. Now, whether the bounce lasts or not, that's a whole different ball of wax, but short-term intermediary bounces typically occur up in those levels, just like you can see one right over here, right? Look at how high the put call ratio is, look at it spiking, and then look at what has happened. So just keep that all in mind. And so then if I'm looking at the VIX, this is a really tough thing to look at when you're saying, well, Tim, how do you, the VIX is up 7% today. Does it matter? I mean, the VIX is, volatility products are just terrible, okay? And so when I'm looking at the VIX here, and this should say VIX in the old quote box there, Can this go higher? Yeah, absolutely can go higher. The VIX has been riding the rail down the last couple of days, so maybe it comes trades up to the mid-level, maybe it spikes all the way up here to 35. But when you say VIX at 26 is too low, you don't know. Do you really know what that means? Is VIX at 26 too low, or is VIX at 50 too low? Is VIX at 50 too high, or is VIX at 26 too high? Because we're going to recover, right? As an economy. So no one, very few people can use the VIX effectively. And so that's why we're going to talk about the VIX futures here in a moment. So when I'm looking at this S&P chart, right, of a weekly, it's a weekly time frame I'm looking at with the mean outlined in purple here, is a bullish chart. And so you're kind of back where we started the week at. And I don't find that to be very bearish. Now, listen, if we close the way we close today, if we close tomorrow the way we close today, I'm looking for a sell-off on Monday. I will tell you that right now. But when I look at today and I see the word sell-off, I'm thinking, geez, people, how long are you? I mean, the headlines floating around, today's sell-off. I mean, how leveraged long are people to call today the sell-off? Doesn't mean it can't develop into one, but today is not a sell-off, my friends. And so when I'm looking at the tool that I find to be most informative for timing sell-offs, in addition to all the things that we talk about normally, like the put-call ratio, where we're at in the moving averages with the indices, which we'll get to in a moment. I'm looking here and I'm seeing 2870, I'm seeing 3020 and 3209. And this is a brand new contract in the August. So this is normal. You're not inverted. And we talk about if you're newer to these videos, just hang with me. I'm going to cover inversion probably tomorrow in the video podcast. I've just done it so much that I don't want to bore the thousands of other people that watch these videos. Look, we're not inverted. And so now that could all change tomorrow. But right now, as we go to bed Thursday night, we're not inverted. And so when I look at, say, the S&Ps, and I will pause here and tell you that we're going to do Tesla earnings, had some trades on Tesla earnings. I want to talk about implied volatility and options, because I want to tell you the market's an equal opportunity dream destroyer. And for those people that were long Tesla, you're like, oh my gosh, those that were short Tesla, you got hosed too. And we're going to go over all of this, okay? And we'll cover more of it in the video podcast this weekend. But when I'm looking at my moving averages, like a 5, an 8, a 21, a 34, a 50, and a 200. The first thing I want to tell you is that these are just lines on the chart. When markets are not normal, these are just lines on the chart, and you shouldn't care about them. Well, Tim, what defines a normal market? We're not in a normal market now. Look, you can have your conjecture, but I define normal market as this. When these are priced out sequentially in normalization, that's a normal market, the way I just described them to you a few moments ago. Big if this price were to close higher than this price tomorrow, that is not a normal market. That's telling you that professional traders, the people that matter in this market, they're willing to take shorter duration for protection now and pay much, much more for it than they are with something that's 55 days left on it. That's not normal. That's an inversion, and you want to pay attention to it. And the last time I pointed it out to you, the very next day the market fell apart. Doesn't always happen that way, but I want you to understand what you're looking for. And it's never one piece of information in a vacuum, okay? It's an amalgamation of the things that we talk about each and every night together. And so, look, this is a normal pullback so far. And then I'm looking at the NASDAQ. The NASDAQ pulls back to the 21. By the time you got to pull back to the 34 in the middle of June. You got to pull back to the 21 here on 6/29. You tried to get there on 7/14, and now you got there today on 7/23. I don't know. I mean, this is where you would say, okay, you're gonna buy something off your watch list, and this is where you would look to get long, maybe something that you've been watching that has a similar formation. The 21 is where you get to take a small position, and look, well, what if it starts closing below the 21? Sell it. This is a very low risk entry point here. This is a very high risk entry point here, because nothing in the history, never ever has something not pulled back to the mean, or the mean come up to meet it, and you're trading sideways. And if you're an options trader, your premium suck is very difficult there if you're a buyer of calls or puts. And so If you're sitting in stock, well, what else are you missing? That's your opportunity cost right there. And so look, right now it's a normal, kind of a normal-esque pullback. And so take that for kind of what it's worth there. And then let's look at the YMs. So we've got a small long position in the YMs. And then the RTYs are interesting to me here. The RTYs, we actually took a long position in the small caps this morning. Bounce off the 8, like it. I look at the ATR charts, I'm thinking, yeah, consolidation. Could these move higher up into this this fib level up here, which coincides with this third ATR? You bet. Is that probably a place to let it go? Probably. Third ATR, you know how that works, right? Hit the third ATR and you typically want to pull back. So hit the 30, when you hit the third ATR, you typically want to pull back. And so now NASDAQ didn't really get up to the third ATR, but you can see it's pulled back to what? It's pulled back to the mean. And so as in the NQs. And so look, I like what I'm seeing here on the RTY. Does it mean it has to go higher? It doesn't mean it's a market, anything can happen. But I'm looking for lower risk entry points, just like we've been doing forever and a day. And speaking of low risk entry points, before I get into trading Tesla options and trading Microsoft options, just to show you some things, and we'll do gold and silver too. Let me show you Meritage. So I kept MTH, and MTH, I got MTH right at the end of June. And from where? Yeah, or the beginning of July, but from this flat base, okay, from this flattish area at the mean, which I remind you, the NQ is at right now. And then you can see what Meritage is done. That's now, it closed just barely higher today, but that's over a 20% gain. And so easily to find a level to stop yourself out. Maybe if you start closing below 1 ATR below, that's a way to stop yourself out at. But finding these low risk moments, and I want you to think about the market was doing in this period of time. You don't have to buy things extended and chase. Like I like Meritage, but I was tracking it as part of an overall set of trades within the bonds, within housing, using bonds as timing to enter Heritage, DR Horton, and Restoration Hardware, and still holding the bonds. So we'll cover that a little bit more on Friday's video. No. What did I sell today? What did I sell? Sold Skyworks. So Tim, why would you sell Skyworks? Because it didn't meet my criteria for earnings and holdings. And so I didn't have a 10% gain going into the print. The risk reward, meaning the options premium in Skyworks, the options premium in old Skyworks we'll get to that in a minute, was pricing in a 4% move or 6% move, and I only had like a little over 1% gain. And so take your profit and move on. And down slightly. I mean, some of you are going to go, Tim, really? That's no big deal. I mean, it's only down a couple points. It is, but I've got rules that keep me out of trouble in case this little bit of loss here after hours turns into something bigger the next day or the subsequent days. I can always get back into it, but it took a very small gain, a little over 1% gain, and wrapped it up. And so that's Skyworks. And then let's do the metals, and then we'll do the option stuff at the end. So GC, gold goes up to, you're talking 2011, 2010 highs here. Gold, 1897, closed at 1884. Look, I love the metals here. I didn't sell them, but you got to know where we are in time and space. Third ATR, okay? So as people want to chase, it doesn't mean they can't go higher, but if I got GLDM, like if you got GLDM or GLD, and you're chasing, just know where you are in time and space. If you're a fan of silver, Don has had a masterful trade in silver and PAS, I believe. But he didn't chase it. He built it from the 21 period exponential moving average. And so look, you can extend off of the third ATR, but that when that happens, that's just not, you want to trail up your stop there, because look, you extend here, you go up a little bit higher, but then eventually you give like most of that back. You're like, well, you're higher now, Tim. You can always get back into it, right? You can always get back into it, right? Look at that. How many days that is. And so you can let it base out. but it's patience to which you need, right? So if you've got SLV, it's almost, look, I didn't even move the marker points, right? It's not on the same chart. So anyway, I don't think you need to chase it here. You know, I've got GL, DM, and I've got GDX. And so, yeah, you can see GDX hits that 38 chart, starts to pull back. GDX is really good about this. It doesn't have to pull back. It doesn't have to be massive pullback. This hit 38 charts, just pulled back to the second ATR, and there it goes. Just see how it behaves. That's all you need to do, is just see how it behaves. Let's talk some options. So I did some things in Tesla that are interesting. So let me see how I can do this, because we've been talking. Here we go. So I've been showing you Tesla, and I want to just, let me just center this up and try to make this coherent, is what I'm trying to do. So I've been trying to educate you as to why you don't want to buy calls or puts right like a day or two before an earnings event. It's really difficult. There's so much premium. Tesla had 204% IV, implied volatility, going into the print. The expected move was 225. So it could have gone from, we'll just call this 1600. So it could have gone from 1600, $225 up, $225 down. Okay. Everybody who bought calls, I mean, I actually sold these. This is yesterday. So this is 7:22, right before the close. Okay. 7:22, 3:57 p.m. market. There you go. 3:57 p.m. screenshot. So when I'm looking at this, I actually bought, to show you, I could buy the 2650, 2700 calls and call spread and actually make money on it. And I did. And so what did I do? I sold my 1500, 1520 call spread. I sold that for money. And so yesterday, going into the close, you know, I had a little bit of profit on the day, but what did I do right before the close happened? I sold a $100 wide iron fly. So I sold the $1,600 call, sold the $1,600 put, which you might know is a straddle. And then I bought the wings for protection. So I also bought the $1,700 call, and I bought the $1,500 put. I took in a credit of $85.50. Now, don't pay. This is just a couple minutes before the close, so it gave me a little bit of profit. And so now, what did Tesla do today? So let's just go to a normal chart, if I can click on it. And so we'll look at what Tesla did today, just in case you're not familiar. So Tesla comes back 5%, loses 80 points. Now, that's a bullish chart, right? Just closes right below the 8. Doesn't mean it can't come down to the 21, but it closes right in the 8, catches itself there. And so right before the open, let's see, is this the one I want? Right before the open today, I believe this is it. Yep, 7:23, about an hour before the open. So this is Central Time. So 7:20, 7:29. So that's an hour before the open, Central Time. This is what I had going into today. There's that $180 gain. So I had that 85, 83. So that stayed the same. But Tesla was trading 1655 by 1657, and it had gone out at 1592. And so there's the implied volatility, the move through Friday, and this is the move that's expected today. That's the market maker move, the range. And so, yeah, I had a little bit of a profit going in. And so then, because there's so much implied volatility, because there's so much tremendous implied volatility, I was still able to get out of this trade today and put on a fresh one for a profit. And so what was I able to do today? So right before the close, now this is a lot less. This was actually closer to a $3,000 gain shortly after the markets opened, and I had planned to just let it bleed, but then Tesla started pulling back. But even when Tesla was trading at 1505, I was still able to sell this for let's see, for about a profit of just over $900. And so I believe that's what I took out of it. And so when I took the screenshot, that's what I took out of it. Yeah. And so that's, even though Tesla had pulled all the way back to 1505, I was still, this is right before the close, I was still able to take a profit out of it. And it has to go with how much implied volatility. This, by the way, this is not me bragging. This is just me explaining something to you. So for everybody that went in and bought Tesla calls, where's my actual quote box? For everybody that went in and bought Tesla calls, let's wait for this to look. You went from 200% IV to 70. You're getting crushed. It's absolute misery. So even if you bought the 1600, you bought at the monies, and look, a newspaper I know and love so well will tell you, oh, you just buy at the monies and you've got limited risk. No, you've got 100% risk of the premium you're paying. And so, look, the expected move is 50 points. You're trading, for the most part, you're trading 1500. And so, you know, if you look a day ago, the 1600s, the $1,600, like, look, we can look together. Let me see if I can show you this. The $1,600 call was what, 110, 10 trade price 110. It was at 103.57. Yes, yesterday. So 101 right there. The 16. Oh, I sold the $1,600 call. Yeah, $1,600 call was pricing out at 101. The $1,600 put was at 108. And so if you're bullish, well, let's look at the $1,600 call right now. It's at $4. So you went from, delete this, I don't know what I'm doing here tonight with you folks. So if we go back to this $101 for the $1,600 call yesterday, 24 hours later, it's $4.70. Man, that's misery. But there's a ton of people that just got crushed by this. It's why I was able to still make a little bit of scratch with a one contract iron fly in Tesla. And so now, what am I thinking tomorrow? So I'm going to take, that's still good money to be made in Tesla, by the way. Now I've sold what have I sold? The expected move is 57, so we'll just call that 60. So what I've done is I've sold. So this trade is done. That was today's. So I've sold the $1,500 call, the $1,500 put. And we don't have any positions in Tesla, by the way, so don't worry about that. I've got the 1550 and the 1450. So I sold a $50 wide iron fly, and I was still able to take in 34.75. And so now we'll see how that settles out tomorrow. So, you know, ideally, if this were to, now it's very rare, but ideally, if this were to pin tomorrow, somewhere near 1500, I'll be able to keep most of what I sold there. If it goes beyond 15, just close it out. Tesla's pretty good about holding its premium, but what I'm trying to explain to you here, it's not the trade itself. It's the IV is so difficult to understand unless you're in here doing it and nobody explains this to you. And so when you buy calls and puts right before an event because you've got a guttural feeling, man, you're just asking for trouble. You're just asking for it. And so you have to understand, like, how many people got crushed today in something like Amazon? I mean, Amazon's down 100 points. You know, 100 points on calls is really, if you have calls, is really hard to stomach. And so you just want to understand what implied volatility really means. And look, the Amazon reports next week, and you'll see this number continue to increase. So if you want to know the number, like once a stock's about to report earnings, just look at the implied volatility. The higher the implied volatility, typically, that's when it's going to report. So this is the weekend. Next week is when Amazon reports. And so I just think you want to understand. Nobody explains it like this. Believe me, it took me a long time to figure all this out, and I wish I had this kind of explanation before. Because you can save yourself. I mean, and you got to understand, like, though the Amazon 32. I mean, where's that screenshot at? These Teslas at 2,700. These Teslas at $2,700 for something that's trading 1,600. $2,700 for something that's trading 1,600 had this market value, $1.42 and $1.41, and somebody was in there buying them right before the close. That's what I'm talking about. So look at the 1,500. See, we'll do this real quick, just so you like. So Tesla's trading 1,500. The 1,500 calls were trading at 156 and 142. 156 and 142. So we'll just to show you the IV crush is what it's called, the implied volatility crush. So let's look Tesla $1,500 calls and calls, $1,500 calls, $30 and 22 respectively. From where? From 156 to 142. Man, and if you're the buyer of those calls and you don't know to sell or do something before the earnings event itself, that hurts. And so, but understanding all this is part of the journey. And so no one wakes up understanding this stuff. And so hopefully that made a little bit of sense. You can get calls, or if you want to get puts before the earnings run, that's fine. But you got the implied volatility is the insulation. You need that IV to rise. If the IV doesn't rise, then it's not insulation. You're going to be subject to price movement. But understanding IV, I think, is really crucial. And so then I did something with Microsoft right before the close, and I don't have any positions in Microsoft for the shop. And so, yeah, Microsoft, I sold 212, 222, 212, 202, and I closed this trade out. Here's 831. I actually got it a little bit better, but this is what it looked like right after the markets opened today. And you can see that's what it was, just taking a little bit of implied volatility. And Microsoft was trading down. So Microsoft had gone out at 212, I believe, and Microsoft is down 2% right at the open, and I'm still making money on this trade. And that's why you want to be the house. When you're directional, it's so difficult. It can be so right in your timing and your price movement. When you're the house and you're selling, when you're Golden Nugget, when you're Caesars, when you're the Bellagio, you can be a little less exact and still be able to achieve your goals. MSFT, let's see what I ended up doing today. And yeah, I mean, 208 on a 1 lot, no big deal, right? But you do a lot of those and you trade small, and I'm demonstrating trading small to you for a reason. It adds up, and it's accumulative. And so you just kind of want to understand all that. So hopefully all this makes sense to what I'm doing. Let me just make sure. Oh, I didn't do bonds. Let me do bonds for you real quick. GLT. So here's bonds. This is such a bullish chart of bonds. Look, I've got bonds I've owned bonds for a while. I'm in at 164.90. I'm not making a killing of bonds. I just like having the bonds because I've been tracking the trade. Look, we get to this third ATR though. I'm probably going to release, I've got a 10% position in bonds. I'll probably release 5% of it, if not all of it. And we're going to discuss bonds. We're going to discuss the metals and bonds a whole lot more on the video podcast, so, as well as some additional options information. I'm going to continue to talk about the VIX inversion in the video podcast, and I'm going to show you that Tesla trade and how it ends up doing. And so look, I don't know how it's going to do. This is probabilities that I think Tesla has an opportunity tomorrow to stay within this expected move. And now I've got it a little inside. I mean, 1550, 1500, 1450, but we'll see if that implied volatility can bleed off any more. And if I can, I'd love to sell this. Someone says, what's your profit target? Typically it's 50 to 80% of this number right here. But we'll see. We'll see what happens. We'll follow up with it tomorrow. So with that, I hope all this makes sense, stock nerds and market lovers. If it doesn't for some reason, and you have questions on it, options questions are difficult to put into email. Just call 855-732-5932. And we'll do our best to answer your questions. And if you ask a good question on email, or by phone, there's a really good chance we just make a video for everybody, so everyone can benefit from the question that you asked. And so with that, I hope it helps, and I will see you. I've got video with you tomorrow night, and all three of us join you for that video podcast. And I'll see you at the next update.